We're going to work right now with our review for Exam 1, Problem 1, which is on the difference between a traditional format income statement and a contribution margin format income statement. So, in the problem, we're given Marwick's Pianos Incorporated purchases pianos from a large manufacturer for an average cost of $2,450 per unit. That's going to determine our cost of goods sold, which is all variable, and then sells them to retail customers for an average price of $3,125. So we're going to use the $3,125 to calculate our sales revenue. The company's selling and administrative costs for a typical month are presented below. During August, Marwick's Pianos Incorporated sold and delivered 40 pianos. So before we solve the problem, let's just quickly go over the difference between a traditional format income statement and a contribution margin income statement. And we're just going to go down to the operating income. We're not going to worry about income taxes or interest income and interest expense. So for a traditional income statement, we start off with our sales or our sales revenue. Then we subtract cost of goods sold to come down to gross profit, sometimes called gross margin. They mean the same thing. Then from our gross margin, we subtract our selling and administrative expenses, and that is going to equal operating income. Now our contribution margin format income statement we start off with the same sales revenue, but then we subtract all of our variable costs. So we're not going to care. I said cost of goods sold is variable, but also some of our selling and administrative expenses are variable. So instead of grouping things by whether they're cost of goods sold or selling and administrative, this time we're going to group them whether they're variable or fixed. So with a contribution margin income statement, if we take our sales revenue and subtract our variable costs, we come down to what is known as the contribution margin. From our contribution margin, we subtract our fixed costs, and that is going to equal the same operating income that we calculated above in our traditional income statement. Later in the semester, when we do cost volume profit analysis and when we do flexible budgeting, we're going to find that for those tasks, a contribution margin income statement is much more useful than a traditional income statement. So let us move on with the problem. Notice that we're going to have to calculate sales revenue in either case, and cost of goods sold is a variable cost. So let's first begin by calculating sales revenue, and let's also calculate cost of goods sold. So to calculate sales revenue, I'm going to take the 40 pianos and I'm going to multiply it by the $3,125 sales price. So I just wrote that down so you know what I'm doing. In Excel or in my calculator, I just take 40, multiply that by 3,125, and I get 125,000 in sales revenue. Next, for my cost of goods sold, I take the same 40 pianos, but this time I'm going to multiply it by the 2,450 average cost per unit. So if I take my 40 pianos, multiply that by 2,450. I'm going to come down to 98,000. Now I'm going to go through all of the selling and administrative costs, because if a cost is variable, we're going to need to know how much it is based on the 40 pianos, and we're also going to have to break them up between the variable and fixed for the contribution margin income statement, so we still have to know what our total variable costs are. The fixed costs we're going to know. So advertising is $700 a month. When it says per month, that's fixed because it doesn't matter what the sales are, 0 or 1,000 pianos, that advertising is still $700 per month. Sales salaries and commissions, that's a mixed cost. The $950 per month is fixed, but the 8% of sales is variable. So we're going to calculate our variable costs. And we have the variable sales salaries and commissions. So to calculate our variable sales salaries and commissions, we're going to take the 8% of sales. We're going to use that. So notice our sales revenue is $125,000. So what we're going to do is we're going to take 8% of $125,000. So to do that, to calculate our variable sales salaries, I'm going to take 0.08, multiply that by 125,000. I could also click on the cell B17, but this is not a lesson in Excel. I'm just showing you how to do the calculations. So the variable part of our sales salaries is going to be $10,000. Next, we have delivery of pianos to customers, $30 per piano sold. So our delivery cost is variable because it's per piano sold. So there are 40 pianos multiplied by the delivery cost of $30 per piano. So our delivery cost, 40 times 30, $1,200. Our utilities are fixed at $350 per month, and our depreciation of sales facilities is fixed at $800 per month. Under administrative, we have our executive salaries, $2,500 per month. Those are fixed. Insurance, $1,000 per month. That is fixed. Clerical, $1,000 per month plus $20 per piano sold. So that again is a mixed cost. The $1,000 per month will be fixed, and the $20 per piano sold is going to be a variable cost. So now we have our variable clerical. So for our variable clerical, we're going to take the 40 pianos sold, multiply it by the $20 per piano sold. I put that in the wrong cell. So if I take the 40 pianos, multiply that by 20 per piano, I have variable clerical costs of $800. Now we have enough information that we can fill in our income statement. So hopefully we can see up on top what we're doing as we fill it in down below. So we're going to start off our traditional income statement. We're going to start off with our sales or our sales revenue. And in this case, we calculated our sales revenue as $125,000. In our traditional income statement, then we subtract our cost of goods sold. And our cost of goods sold is $98,000. And if we take our sales revenue and subtract our cost of goods sold, we're going to come down to our gross margin. So our gross margin is $125,000 minus $98,000, which is $27,000. Now, from our from our gross margin, we now subtract our selling and administrative expenses. So we're just going to list the selling expenses. The only one we really have to calculate right now is the sales salaries and commissions, because part of it was fixed and part of it was variable. The other ones are either fixed or variable, and we already calculated the variable delivery cost. So for our selling expenses, we had advertising of $700. The next one that we have after advertising is our sales salaries and commissions. And once again, that one is a mixed cost. So the fixed portion was $950, and then we calculated that the variable cost portion was $10,000. So our total sales salaries and commissions is the fixed portion, which is $950, plus the variable portion, which is $10,000. So that is going to equal $10,950. So under our sales salaries and commissions, $10,950. The next one that we have after sales salaries and commissions is delivery. Delivery is variable. We already calculated that is $1,200. The next one after our delivery is we have utilities of $350. And finally, the last one that we have is depreciation of sales facilities, $800 per month. So we have all of our selling expenses. Now we're going to have to do exactly the same thing with our administrative expenses. So under our administrative expenses, we have our executive salaries, $2,500 per month. After that, we have our insurance at $400 per month. After insurance, we have our clerical cost, also a mixed cost. So the fixed portion is $1,000 plus the $20 per piano sold. The variable portion was $800. So our total clerical, fixed of $1,000, variable of $800, $1,800. So under here, under our clerical, $1,800. We only have one more cost, which is depreciation of the office equipment, $300 per month. So it's calculated our total administrative expenses. We've calculated our total selling and administrative expenses. So our net operating income is going to be our gross margin of $27,000 minus our minus our total selling and administrative expenses of $19,000. So that is going to be $8,000. All right. Now that we've got requirement number one, Let us now move on to requirement number 2. So, under requirement number 2, we're going to start off with our same sales revenue. So just sales. And they want us to do the total and the per piano. So our total sales revenue is $125,000. And the per piano amount that they gave us is $3,125. Now for our variable expenses. Our first variable expense is cost of goods sold. And we calculated that off to the right is $98,000. And it was given in the problem that our average cost per piano is $2,450. Now we just have to find all of the variable expenses under selling and administrative. So whenever it says per month it's fixed, it's going to go in the fixed. But if it says per piano sold or a percentage of sales, then it's going to be a variable cost. So we have 2 variable selling costs. Only the variable part of the sales salaries and commissions. We're not going to add the $950. We're only going to use the 8% of sales. And the delivery of pianos to customers, $30 per piano sold. And we only have 1 variable administrative expense, which is going to be, once again, only the variable piece of the clerical of $20 per piano sold. We're not going to include the $1,000 per month in our variable costs. So now that we've got our variable cost of goods sold, the next variable cost that we have is our sales, salaries, and commissions. And we calculated just the variable part of our sales, salaries, and commissions as $10,000. So again, here under the variable, we will not add the fixed portion of $950. So it's just the $10,000. Now there's 2 ways that we could calculate the per piano. We know that we're selling 40 pianos. So the first way is to just take the 10,000 pianos. The $10,000 sales, salaries, and commissions and divide that by the 40 pianos. So that would give us $250 per piano. Another way that we could calculate it is that we know that it's 8% of the sales. So it would also be 8% of the selling price. So if I took 8% and I multiplied that by $3,125, I would get the same $250. So either way you look at it, you just need to be able to calculate the $250. The next one we have is our delivery cost. We've already calculated the variable delivery cost. So that one was $1,200. And they gave us that one was $30 per piano. It was given in the problem. So we really don't have to calculate that. Now we've got our variable sales, salaries, and commissions. We've got our delivery of pianos. The other 2 selling are per month, which means that they're fixed. So we only have 1 variable administrative, only the variable part of the clerical. We're not going to include the $1,000 per month. So our variable clerical is just going to be $800. And they gave us in the problem that was $20 per piano. Now we've got our total variable expenses. So now we can calculate our contribution margin. So on a total basis, our contribution margin is $125,000 minus $110,000, which of course is $15,000. We could divide that by 40 to get the contribution margin per unit, but our per unit contribution margin would be the $3,125 sales per piano minus the $2,750 total variable expenses per piano, and we come down to $375. Now all we have to do is list our fixed expenses. Advertising, $700 per month. The next fixed one that we have is sales, salaries, and commissions. Now we're only going to include the fixed $950 per month. The 8% of sales was included in variable, so the sales, salaries, and commissions is only going to be $950. The next fixed cost that we have, the 8% of sales is variable, $30 per piano sold is variable. Our utilities of $350 per month are fixed. And then finally, from the selling, our depreciation of sales facilities, $800 per month. Moving on to the remainder of the fixed costs, we have executive salaries at $2,500 per month. The next one we have after executive salaries is insurance at $400 per month. We pick up only the fixed portion of the clerical. The $20 per piano sold was picked up in the variable costs. So in the fixed costs, we only pick up the $1,000 per month. So notice that our two mixed costs, the sales, salaries, and commissions, and the clerical, they appear both in the variable expenses and the fixed expenses, and the total will total the total expense that's in the selling and administrative part in the traditional income statement. So we only have one more, our depreciation of office equipment, $300 per month. Now that we've got our total fixed expenses, we take our contribution margin and we subtract our fixed expenses to come down to our net operating income. So $15,000 minus $7,000 gives us $8,000, and it should be the same operating income that was calculated in requirement 1.